What would you say if I told you two investors could have the same investment portfolio over the same time frame with the same fees and end up with a different amount of money? If you're within 5 to 7 years of retirement, this is a very important concept you need to understand before it's too late. Welcome back to the show, everyone. I'm Matt Nelson, and I've been helping people retire for over 25 years. We look at what works and what doesn't, retirement planning and tax strategy and more. Now, today we're going to talk about something called sequence of returns risk. This is one of the most important concepts you need to understand as you're coming into what we think about as the retirement launch zone. That's about 5 to 7 years before you actually turn in your papers, retire, have no more regular income. Now, it also includes a period of probably 5 to 7 years on the other side of retiring as well. The reason that these two time frames are so important is because when you see negative returns in a portfolio, and you will at some point in your investment career, it really matters when they come in. Do they come in at the end of an accumulation period, or do they come at the beginning of a withdrawal period? So we're going to look at this concept. A lot of times people think about returns and they just want to add them together and make an average. And while that is technically the average, it doesn't speak to the compounding of wealth. So we'll look at this concept. If you have made 50% and then you lose 50%, or the other way around, your average return is actually zero. But that doesn't speak to what the dollar value of what you would have would be. So let's look at the concept here, breaking even. If you have $1 and you lose 50%, you now have 50 cents. You actually have to make 100%. You have to double your money from this point to get back to even. And this graph really gives us a look into how badly negative returns affect portfolios. Let's say you lost 10% in a year. You actually, the next year, would need to make 11 just to get back to even. And when we start to look at some of the bigger declines in the markets, let's just say the year when we had COVID and there was a decline in the market, or the 2022 decline, or maybe some of the bigger declines, the financial crisis and the tech bubble. When we have those types of declines and your portfolio goes down 40%, you got a lot of work to do just to get back to where you started. One more illustration here, just a simple spreadsheet that I made to help look at this with some numbers. And then we're actually going to pop into my financial planning software and show you the real life example on a sample portfolio. So what I created here in this spreadsheet to try to make this more relevant, what I've shown is $1 million portfolio. We're going to start with both of them the same, no withdrawals. Okay. 7% rate of return all the way out for 18 years, and then 2 years of negative 13. So lucky 13 there for 2 years in a row. On this side, in the green investor, we've got the negative 13s in the front end. Okay. At the end of the period, they've both averaged 5% a year. So all of these returns are going to average 5%. Portfolio, as you'd expect, ends up the same level. Now, when you add in a withdrawal of, let's say, 5% starting balance, and again, this is very simple, just $50,000 a year, same amount throughout the period. The portfolio that has the negative returns at the end actually has made money over that time frame. Portfolio is now worth 1.178. However, on this side, where we started off with the negative returns, just 2 years of negative returns, we've actually are seeing the portfolio down to 540,000. So it's like half of the portfolio that gets the negative returns at the back end. Okay, now let's jump into the planning software and take a look at a sample portfolio, a sample client, and see how this really plays out in a little more real world setting. What I have set up here is an investor age 50. They've got $1 million portfolio. I've named them sequence of returns. Their cash flow, I have them set up to be earning about $150,000 a year salary. And that's going to continue out inflation adjusted until they retire at age 66. And then they'll start to begin to collect Social Security along the bottom, and they'll take portfolio withdrawals out of their investments. The difference between the yellow here is just pre-required minimum distribution withdrawals, and then the orange level is showing required minimum distributions. But at any rate, I don't have them saving. We're just making this very simple. $1 million to start with, no savings. They continue to work, and then they start to withdraw it at retirement. Okay, now, how does this look? Everything works out just great. They actually grow the portfolio over time, and they've continued to draw down their expenses. However, when we put at the front end, we have early negative returns. What I've added in is just 2 years of negative 13% at the start of their retirement. And so if we look through this column about the annual growth rate, we can see here at age 66, we've got 2 years there of negative 13%. And then we go back to the regular average. So I haven't disrupted this much at all, just 2 years. What happens though, is you'll see we went from everything being just fine with the average rate of return, ending their retirement with over $5 million, to adding just 2 years at the beginning of their retirement actually has them running out of money before age 95. Right around 91 is when we see the portfolio be fully depleted. Now, if we compare that to having negative returns a little bit later in the retirement, we'll look at this situation where all I've done is move those 2 negative years of 13% out to age 76. So just 10 years into their retirement, I add in 2 negative years of 13%, and then I go back to the same average. Now, what does that look like? We actually have a scenario now where there's enough growth still in that first 10 years of retirement. The portfolio certainly takes a hit, but we actually don't see this investor running out of assets. So what can we do to fix this? Well, there's several different ways. I'm just going to go through 5 briefly. The first is, as you're entering that retirement launch zone that we think of, when you get in within about 5 to 7 years of the time frame when you might actually need to start withdrawing from your portfolio, you need to start raising some of your growth investments into shorter term vehicles like cash, treasury bills, CDs, things that won't have much fluctuation at all, and it'll be ready for you to spend when it's time. The second item that you can pay attention to is really evaluate the investment markets as you're approaching retirement. If you're coming into a year, let's just say like 2022, when the markets were very difficult for most investors, if you had planned to retire at the end of 2022 and you were meeting with your advisor or evaluating things on your own, and you saw that the stock markets were having a lot of difficulty that year, if you could delay retirement even 6 months, a year, it makes a tremendous amount of difference. So thinking about retiring just a little bit later based on what's happening in the markets right before you retire, another very solid strategy to help deal with sequence of returns risk. The third way to deal with this risk is to think like a pension plan. You want to think about having a portfolio that's liability driven, not just based on your risk tolerance. So what I mean by that is think about the amount of money you're going to need to spend over the next few years, set that aside in instruments that are available to spend, and back into how much you need to have in growth investments. Don't just take some simple risk tolerance questionnaire and let that drive all of your investment decisions. So think like a pension plan. Think about what the portfolio needs to do and let that drive your investment portfolio decisions. Now, I'll give you some examples of how this could work. We've talked about setting aside, let's say, 5 to 7 years of your portfolio for spending. So for instance, if you're more comfortable having a large portion of your portfolio in the stock market and the growth investment side, maybe you only set aside 5 years worth of these spending instruments. Well, 5 years times, let's say, a 5% starting amount that you need to take out of the portfolio is 25%. That gives you approximately a 75%, 25% portfolio, 75% growth, 25% income or spending account. You take that a step further. Let's just say you want to be a little more conservative. You're more comfortable having 7 years worth of this spending set aside, and you're using the same 5% withdrawal rate. Well, 7 times 5 is 35%. That gives you about a 65-35 portfolio. So this is very connected to reality, but what I want to emphasize is think about your spending need versus your risk tolerance first. Think like a pension plan. Now, number 4, we need to think about to mitigate this sequence of returns risk is portfolio strategy, and rebalancing does matter. This is where having an active advisor or being active yourself in evaluating what portion of your investments are up this year. Maybe we should take profits off of those, let others run. Don't just blindly rebalance your portfolio and sell something every year to replenish your spending bucket. So for example, let's say technology stocks have been on a run. They're up significantly compared to the rest of the portfolio. Makes a lot of sense to pull some profits off of those, put them back into the treasury bills or to the CD portfolio. If on the other hand, technology stocks might be down this year, maybe your real estate portfolio, maybe the dividend stocks that you have been doing a little bit better, that's where we're going to raise cash from. That's a very different process than just simply selling across the board. And the last item is to just be flexible with your spending. So instead of relying on just a rule of thumb, 4% withdrawal rate, and just blindly take out that amount every year, adjusted for inflation, you need to think about a dynamic strategy. Maybe we set a target at the beginning based on your spending need. And if the portfolio has been doing better than expected, it's easy to create a raise for yourself. If on the other hand, we go through right as you begin retirement, have a year or two of poor returns, we may need to revisit the spending strategy, maybe reduce it a little bit in those early years so that you can catch up later. So this has to be dynamic. You need to be flexible, especially in that window of about 5 years on either side of retirement. So to wrap up, the sequence of returns risk is a real risk that you need to pay attention to as you come into retirement and that first few years into retirement. You need to think about staying flexible with your retirement dates, with your spending amounts. Think like a pension plan, be liability driven versus just driving your investment portfolio based on a risk tolerance score that you receive. Be active with your portfolio management. Attempt as much as possible to sell portions of your portfolio that are up to replace your spending bucket. Don't just blindly sell across the board. If you found this helpful, subscribe and check out our channel for other videos on retirement, investments, and more. And remember, financial freedom takes more than money. So find your purpose and make a plan to live your life well. We're here to help.
Investment advisory services offered through Savvy Advisors, Inc. Other entities and/or marketing names, products, or services mentioned here are independent of Savvy Advisors, Inc.